And next, T. Rowe Price's Brian Rodgers. Brian and Bill are going to bat around some stock names and talk about investing hits and misses. We'll be right back. Brian, welcome. And, we decided any talk of potential mergers between Legg Mason and T. Rowe Price would be inappropriate for this conversation. So let's start with your overall market view. Brian, we've been, Lee Cooperman's bullish. Bill was saying he's bullish. Thought the market was 20% undervalued. What do you think?
Well, Aaron, it's good to be with you. We don't make market forecasts here, but it feels to us as though the underpinnings of the equity market are in pretty good shape. So we're coming right through earnings season, and the numbers are really good. Dividend activity has been really positive, and there's some signaling content in that. Corporate balance sheets are strong, and what we're seeing is the individual investor beginning to move out of that money market fund yielding 1 or 2 basis points back into riskier asset classes. So the liquidity demand has been fairly evident this year. I was telling the other day, just looking at the fact that probably a third of the companies in my fund have raised their dividends in the last 5 weeks. And that's really unprecedented. So there are a lot of good things going on out there.
Where do you see, Bill, when you talk about 20% undervalued, where is the biggest, what's going to do the best in that world?
I don't know what's going to do the best, but I can tell you what the cheapest areas of the market are. I mean, we're contrarian value investors, so normally when we're involved in something and people are scratching their heads, they're just saying, you're obviously wrong, or it's not clear why you're doing this. But the 3 cheapest areas of the market, so by cheap I mean they've been more expensive than this 90% of the time. So the bottom decile of historical valuations are financials, number 1, technology, number 2, and healthcare, number 3. Those are our biggest overweights in our fund.
All right, we're going to get to names in a moment, but first, Brian, I wanted to, Bill was curious because exchange-traded funds for a lot of our viewers have become, well, something they hear about all the time, they see all the time. You both are mutual fund managers, so we thought it was worth talking about the role of ETFs. And just to let you know, Brian, who rang the opening bell this morning, Credit Suisse celebrating the listing. Are you ready? Make sure you get a pen out and get ready for this one. 2 times monthly leveraged merger arbitrage liquid index ETN. Now, if you know what that is, you got one up on us. ETFs, are they good for investors?
Well, Aaron, I think ETFs serve a useful purpose. I would view the one you just described as giving the individual investor a loaded revolver. So I think some ETFs are great and they serve a real purpose, and they're really just a different way to buy investment exposure. I think some of the marketers have gotten perhaps a little too creative with some of these things, and I can't even repeat the one you just described. But some of the levered ETFs, to me, really seem dangerous to me insofar as the individual is concerned.
Yeah, I'll just add on to that. Actually, and again, full disclosure, I happen to be short a couple of these triple levered ETFs, the triple levered bearish financial and the triple levered daily large cap bearish fund. But the way the math of this works is that effectively all you've got to do is get roughly the trend right if you go against these triple levereds, and because it's daily compounding and it's arithmetic, not geometric for people that care about that stuff. But I do agree with you that it's a quick way to lose a fair amount of money if you don't know what you're doing. But Brian, let me ask you this question: are you guys seeing one of the issues with ETFs is it appears to me to be a potential disintermediation of traditional asset managers? So especially broker sold funds where they can have their own internal asset allocation models and then build portfolios that way. You have a view on that at all?
Yeah, Bill, first of all, when it comes to fancy ETFs, let me just say I'm not worried about you. I know you know what you're doing. It's my aunt in Massachusetts I'm worried about. So I think there has been some disintermediation, as you point out. We are in the process and actually have submitted an application to the SEC for an ETF product, and it takes them a long time to act on these things, but we'll get there and we'll try it out. But we'll be very cautious when it comes to introducing products that way, because I think we have to protect what we're doing. And frankly, the rest of our business is doing so well, we don't really feel as though we need the extra distribution that we get from a series of ETF products.
All right, I want to get to some picks here so we can go through them. Let me start with you, Bill. We said you liked old tech, so make the case quickly for JP Morgan.
Well, JP Morgan's not old tech, right?
Oh, I mean, I'm sorry, Microsoft. And then I looked down on my sheet because I had JP Morgan first. Microsoft first, then JP Morgan.
Microsoft. Okay, yeah. So Microsoft is a name that I have not particularly been enamored of for a long time. But I think Microsoft, we had Rich Templeton on earlier, I think Microsoft is becoming, or is going to become, a leader in capital allocation in tech. So here's a company that has a 44% return on equity. So it's got a return on equity of at least 3 times the equity market. Right. It trades at under 9 times next year's earnings against around a 13 multiple on the market. So cheaper than the market on that. It's got 2.5% dividend yield. It's a higher dividend yield than the overall market. It's got a better balance sheet in the market. It's got $40 billion of cash on the balance sheet. They raised the dividend 23% last time they raised it, and they bought back $13 billion worth of stock in the last 3 quarters alone. So it looks to us like that Microsoft is finally going to really start using their cash to return it to shareholders, and it's just way too cheap at this level.
Brian, what about you? Why don't we do your tech name, HPQ?
Yeah, Aaron, I also have exposure to Microsoft, and I agree with everything Bill said. Hewlett-Packard is another company in the same category. It's been a very disappointing stock. Earlier, my old friend Jim Cramer mentioned exciting names in the Dow. I'm trying to invest in unexciting names in the Dow, and I think Hewlett-Packard fits that mold. I was going to say it has one of the highest free cash flow yields in the business. It is not without controversy. There have been governance stumble after stumble over the last couple of years. But I think it's a company where the pressure's on, and they know they have to improve their performance. And the way I look at things, it's very inexpensive, selling in a low double-digit free cash flow yield.
One more for you, Brian. I know Bill was curious about this one because it's a local company for both of you. Quickly, Constellation?
Well, I think when you look at what's happened over the last couple of weeks, one of the sectors that's been most severely hit has been the electric utility sector. And I think the good mid-sized companies in that sector, again, selling 9.5 times earnings, 3 to 4% dividend yields depending on the name, some higher, very much out of favor. And I suspect we'll look back when we view the importance of nuclear power to this country. We'll look back 18 months out and see this was probably a pretty good buying opportunity.
All right. Well, Brian, thank you very much. We appreciate it. We're going to get to Bill Miller, and there are a lot of things we wanted to get in. We're going to try to squeeze a few in here at the end of the show. First of all, your other top plays right now. One of them was quite surprising because it's an airline.
Well, the airline industry is surprising. The airline industry certainly probably the worst industry in the history of the world to have invested in. Operating leverage, financial leverage, unionization, regulation, bad service, capital intensity, bankruptcy. But the airline industry is changing. It's changed a lot. It may not have changed enough, but right now you've got the 2 big carriers, Delta and UAL, control 50% of the business. Add AMR's 15 and Southwest 10, and you're up there in the 75% range with only 4 carriers, 2 of which have new return on capital requirements in their business. So what you're seeing right now is we're flying fewer seats than we did in 1982. You're seeing significant profitability with a lag with the fuel price increases, but we still expect, going into this year, if fuel had stayed where it was, we expected UAL to have $6 a share of free cash flow on a roughly $21, $22 stock. That's sort of gone out the window with the fuel price stuff, but they're making that up with fare hikes and surcharges. But broadly speaking, we think this is an industry that could do what steel did in the early part of the decade. No one would have thought that U.S. Steel was going to go from 15 to 150, but it did. Nobody thought Apple would go from 3 to 300, but it did. And this is an industry where UAL could easily, in several years, be a $75 or $100 stock.
And JP Morgan, 5 seconds, best bank for you?
Well, JP Morgan, I think, is the best bank in the world, and the key there is we think they'll do $6 of earnings in 2012. They're going to pay a 30% payout ratio. That's a 4% dividend yield, a 10 times multiple, and you're at $60 easy.
And your greatest mistake? I mean, you've had your long-term track record's great. You obviously have had some very tough years too. What's your biggest regret?
In addition to not retiring in 2006 after 15 years of beating the market and coming back at the bottom. No, I'd say the biggest regret was certainly getting the financial crisis wrong. We have very robust strategies for dealing with virtually every kind of market disruption, from inverted yield curves to the crash of '87. And that was a case where we just didn't quite get the difference between a liquidity-driven crisis like '87 and a collateral crisis like 2008.
All right. Well, Bill Miller, thank you so much. We really appreciate your taking the time and bringing all those great guests along with you.
Thanks for having me. Appreciate it.
Bill Miller of Legg Mason Capital Management. If you missed any of the show, go to our website. It's dedicated to our show today. And now we're going to send it off to the closing.